In today's video, traders, we're going to be talking about a simple strategy that works again and again in the currency market. Now, there's no such thing as a guaranteed profit, but this is a strategy that I have used for years now. It is one of my favorite ways to trade the currency market, and I'm very excited to share it with you. Let's get into the video right now. Hello traders, and welcome back to my channel. Do me a big favor, if this is your first time here or you're enjoying the video, make sure you subscribe down below. And also, if you enjoy my videos, show some love, show some support for the channel, and give this video a thumbs up down below. It helps to show myself as well as others that you're enjoying the content that I'm putting here on YouTube for free. With that said, with that out of the way, let's get into today's video, which is talking about one of the simplest ways that I know that you can actually make money in the currency market. And it's actually very, very simple. Is it going to make you print money like there's no tomorrow? Maybe, maybe not. No such thing as an easy strategy, but this is a simple strategy. There's a big differentiation there, right? A simple strategy means that it's something that is not overly complicated. An easy strategy means that you just sit there and lay on the beach while you print money. Not necessarily this. This is a simple concept that I've used again and again in currency trading to my favor. And what is it that I'm talking about, Nick? You're leaving us all hanging here. Well, simply put, what I'm talking about is using the carry trade or positive swaps to your favor. Now, if you don't know what positive swap means, essentially we're talking about a concept where certain currencies pay higher interest than others, and there's actually a differential there, and we get paid to hold certain positions. For example, if you hold USD CHF, this is dollar versus the Swiss franc, if you hold this position long, you actually get paid to hold that position because the US dollar is paying you a nice amount of interest, and the Swiss actually has a negative interest rate in their country. I know it's a little bit confusing, and if you're still confused before we go on with this video, make sure you check out this video, which is the carry trade video that I did, explaining this in more detail. With that said, let's carry on. Again, using this concept is something that I have used again and again, and I implement in almost every single one of my trading strategies that involve some sort of swing trading or position holding, right? So intraday may not be the end of the world to go against a positive swap, but generally, when something pays a nice positive swap, you get paid a general amount of interest or a decent amount of interest just for holding a position for some period of time by your broker. And in fact, today I'm actually going to show you a tool that you can use to calculate this. So stay tuned for that. Definitely very, very excited to show you guys that. It's something that I use on a regular basis. But essentially, interest rates are something that are super, super important from a fundamental standpoint, right? Interest rates are going to tell you what different currencies or their banks are paying out in terms of holding their currencies. Now, this is very, very important for the currency market and actually drives a lot of trends and momentum in the currency market based entirely on this interest payment or lack thereof, right? So the information that banks come out regarding interest rates is very, very important because there's so many traders around the world, as well as banks and commercial institutions and all sorts of different groups using the carry trade to their advantage. Me as a Forex trader, a retail trader, I can still use this, and so can you. That's why I use it on a regular basis. So with that concept, out of the way, let's talk about how you can actually use this. Let's give you guys some examples first. And what I'm going to do is I'm going to start with euro dollar. What you can see is we're looking at euro dollar, and take a look at this market. If we zoom out, take a look at what we see, guys. Do you notice how the overall market has been down very, very strongly for quite some time on euro dollar? This may be coincidental, but I think that part of it has to do with the interest rate differential of this currency pair. Well, Nick, what are you talking about? That's where I'm going to get this website in here. I'll put this down in the description if you'd like to check out this website. It's a service that's free, offered by Oanda. You can use this. Actually, I'm not sure if this is free or not. If you don't have an Oanda account, I'm not sure if you can use this. Make sure somebody lets us know in the comments down below. But essentially what you can use is you can see I'm logged into my account and I am taking a look at the currency financing charges calculator. Fancy word for, hey, how much does this currency pay or cost me to hold overnight? Now, what you can see is, let's say that we use a standard, let's say that we do 10,000 units. This is basically a 0.10 lot size position. And let's say that we held this position for 24 hours, okay? Everything else you can kind of keep the same unless you trade in some other currency, right? For if you're in Canada, you can use CAD, whatever you're kind of just plug in here. And what you can see here is if I set this to a buy position, you see that there's a negative 0.9% borrow rate. And so when I calculate this, you can see Every single day I hold a buy position on Euro USD, I'm going to get costed or deducted from my account $1.03. Now, it doesn't sound like a lot, but over time, taking money out of your account can really stack up, especially if you start using those bigger position sizes. However, take a look at this, guys. If I zoom in just a little bit, I think this is probably a little bit too small. If we zoom in just to look at this, look at how if I set this to short, right? If I'm shorting euro dollar, take a look at this. Now I'm getting paid 61 cents just for holding this 0.10 lot position. Now, this is not a lot either, but over time, this is really cool because I've used a positive swap rate in a lot of my trades on purpose so that I can collect interest overnight. Now, I know this is not going to be a lot, but you have to remember, guys, trading is not something that happens overnight. It's something that happens over time. And so with this said, when we're looking at Euro USD over the long term, you can see that the overall market kind of drifts downwards. And part of that is probably due to the fact that there is a positive swap if you hold short positions open on Euro USD. So with that said, you can see that overall the market tends to drift downwards because people are likely trying to play this positive swap rate. It's not a super hard thing to do. Remember, I said at the beginning, this is a simple strategy that can improve your kind of just overall profitability in the Forex market. Is it going to make you rich? No, 61 cents per day is not going to make you rich. However, over time, this is something that you can add to your toolbox, and instead of paying a ton for swaps, you can actually collect positive swaps on your account, and over time, it actually does add up. I think that last year, I think I brought like 2 or 3% by itself just from positive swaps on my account. It may not sound like a lot, but let's say that you did 15% for the year in actual trades, and then you had 3% in swap rates. Well, now you have an 18% year, which is much better, right? So it doesn't sound like a lot, as opposed to if you were trading against that positive swap. Well, in that case, you might have went 15% and then deducted like 3 or 4% off of those winnings, right? So then you only have 11%. So using this positive swap, guys, is something that I personally love. I use it in my trading strategies all the time because I find this a super simple way to kind of increase the profitability overall when trading currencies. So with that said, another one that I'm going to look at is something like CAD Swiss. Okay. This one doesn't have the US dollar. The US dollar currently at the time of making this video pays a very nice percentage return for holding it, but Canadian dollars also do as well. So what you can see here is that you get paid. If we go back to our tool really quick and we take a look at CAD CHF, and let's say that you can see in this case, if we hold our 10,000 units short, we actually pay 76 cents per day. But take a look at this. If we swap it to the buy side, look at that. We get paid 30 cents per day just for holding that small position size open. Now, again, if you're using something like a full lot, that ends up being $3 a day. And if you start getting your calculator out, if you really want to get fancy with it, $3 times 365, because the currency market is 24/7, right? Just because you can't trade it doesn't necessarily mean there isn't currency still in the universe, right? Or in the world. We still have currency and we still have exchange rates even on the weekends. It's just that retail brokers don't allow you to do that. So anyways, if we add that up, look at that. It's $1,100 roughly added to your account for holding positions, right? That are just in the favor of a particular interest rate. Now, these interest rates can change, and that's why you want to kind of keep an eye on some sort of fundamentals. That's why I'll pay attention to interest rates, because it really does dictate how I look at my trading strategy. Now, whatever I'm doing, even if I'm looking at kind of short-term pullbacks, right? If I'm doing swing trades on the 4-hour chart, I may only look for buy opportunities. So if there's a downtrend like this and I'm not really interested in getting involved in the short side because I'm going to pay that negative swap, then maybe I just look for positive swaps in something like an uptrend or at a particular level. For example, on CAD Swiss, let's say that you identified this level as a major structure. Right now we've seen it chop around, but you're getting paid this entire time just to hold that positive position, right? Because you're getting positive interest for holding this market. Now, this is really cool to me, and I know it's not like super, easy money, but for me, it's something that I've really liked to add into my trading strategy. I like to trade in the direction of the positive swap as often as I possibly can. Now, I will trade against it, but remember, it costs us money to trade against the interest rate differential there, because if you're not receiving it, then you're paying it, right? So it can be expensive over time when you're having lots of swing trades and you're paying a lot of swaps and it can really add up over time. But if you do the inverse, if you buy only in the direction of a positive interest currency, this can be a really easy way to just add on a couple extra percent per year. Guys, I hope you got something out of this video. Thanks so much for tuning in. I've got more videos for you to check out, so make sure you stick around and subscribe to the channel. Thanks so much, guys. We'll see you next time.